Looking at daily stock charts often feels like staring at random, chaotic noise. But within that volatility, there are specific structural shapes you can use to establish order, like a bearish formation known as the descending scallop. Today, you will be able to identify the distinct reverse J shape of this pattern, confirm its validity using underlying volume data, and set exact entry and stop-loss levels for your trades. To follow along, open your charting software, set your view to a daily time frame, and ensure your volume indicator is clearly visible at the bottom of the screen. Learning to filter out daily market noise and focus strictly on repeatable structural patterns is your first step toward professional-grade risk management. We start with the macro environment. For a descending scallop to be a valid setup, the overarching price trend leading into the pattern must already be pointing downward. This chart shows the reverse J anatomy of the descending scallop. We look for three coordinates: a high starting peak on the left at point A, a rounded bowl finding a low at point C, and a lower right lip at point B. There is a specific mathematical relationship here. The right lip at point B typically retraces about 60% of the total vertical distance from the bottom of the bowl. Focus closely on that bowl at point C. You need to see a smooth, rounded saucer bottom. Avoid patterns that form sharp V-shaped bottoms, as those lack the necessary price consolidation and often lead to false breakouts. Price shape alone does not confirm a trade. We have to validate the market's conviction by analyzing the underlying volume. This chart shows the volume pane below the price action. Notice the overarching dome-shaped trend forming in the volume bars. This specific dome profile appears in roughly 70% of valid descending scallops. You will also frequently spot a distinct volume spike near the center of the bowl. This occurs exactly as the price finishes declining and transitions into its upward retracement. When you align that smooth, rounded price consolidation with a dome-shaped volume profile, you lock in the structural criteria required for a high-probability trade. Even a perfectly drawn shape will fail if it fights the broader market context. You have to align your setup with the prevailing macro trend. Looking at historical performance data, upward breakouts suffer from high failure rates. However, downward breakouts executed during an established bear market fail only 8% of the time. Because of this heavy structural bias, you should exclusively trade the descending scallop as a short position during a bear market, targeting an average price decline of 23%. Before executing, you must scan the chart for overhead resistance. Previous price peaks create structural ceilings that will trap upward momentum and reverse the trend. This chart shows a descending scallop attempting an upward breakout. Notice the solid horizontal resistance line near the 46 level. The breakout fails precisely at that line. The ceiling provides too much supply for buyers, forcing the price to reverse direction. Be aware that the bottom of the scallop's bowl also creates a localized support zone, acting as a floor that can temporarily stall a downward breakout. Mapping these structural ceilings and floors before putting your capital at risk is how you filter out trapped setups. Your mechanical entry trigger for a short position is a daily close below the lowest low of the pattern's bowl. This chart shows the breakout line drawn at the pattern's absolute low. You must wait for the daily candle to close before executing your trade, as intraday dips often reverse. Intraday dips often trap impatient sellers. The specific daily candle in the Ingo chart closes decisively below the support line, providing the confirmed entry signal. To calculate your target price, measure the total height of the pattern from peak to bowl and subtract that distance from your breakout price. Your protective stop loss is placed slightly above the right lip. If price breaks above that peak, the bearish structure of the scallop is entirely invalidated. Use the oddball number technique for your stop placement. Instead of choosing a round number like $21 flat, set it at $21.07 to avoid common institutional stop hunting zones. Defining strict entry conditions and hard stop-loss placement removes emotion from the process, leaving you with a highly repeatable execution system. You now have the full operational framework. You can spot the reverse J-shape, validate it with a dome-shaped volume profile, filter for bear market conditions, and map exact execution levels. To build fluency, open your charting platform, scroll back to a historical bear market, and identify 3 descending scallops to track their final results. Remember, trading involves a significant risk of loss and is not suitable for all investors. This content is for educational purposes only and does not constitute financial advice. Extracting profits from a declining market requires discipline. Wait for the rigid structure of the descending scallop to appear, confirm the data, and trade the system.